Okay, everyone. Thank you so much for joining. It's been a bit of a couple of months of me being off of these webinars. I am back on. I have had a few technical issues of late with this. So basically what's going to happen, unfortunately I can only work off one screen for these webinars now. So because I'm working from a virtual PC, it's all gone a bit crazy. But what I'm going to do is I as big of a chart as possible. So I'm going to show you my whole chart, and then every so often, like every 10 minutes, I'm going to look for your questions. So if I don't answer your question straight away, please bear with me. I will get to them, but as I said, just bear with me just while I have this. Thanks everyone for coming back. I know some of you have joined me before, so it's great to be back and good to be chatting to you guys again. Now let's get started. I'm just going camera, and then as I said, I will check every so often to see if there's questions and answer them as possible. And answer them as much as possible. I'm going to go through, I'm going to start by just giving a little bit of context of what's going on. We're just going to take a look at the euro first, gold. I want to look at pound. I want to look at the Aussie dollar, and I want to look at euro yen. These are weekly webinars at the moment, so we're going to try and kind of squish in as much as possible. But as I said, please bear with me if I don't answer your question at first. Don't let that put you off. I will get to it. But I just have to kind of balance two things at once anymore, unfortunately, because I'm only on one webinar. So right, let's put you guys away. I'm hoping you can all see my Aussie dollar. Just double checking. I believe you can. And let's start not with Aussie dollar at all. Let's start with some euro, shall we? Let's get on to it. As you can see, 60-minute chart. The euro has had quite a fantastic jump higher. Just double checking it. Yes, everyone can see. That's great. The euro has had quite a fantastic summer since we've been gone. I mean, it wasn't that long. Doesn't seem that long ago that I was talking to you and certainly to my other clients here at forex.com that we might get 120, we might get sub 120. Well, that all changed. And that all changed end of July, so just before the Olympics started, when Mario Draghi made that speech, didn't he? Saying that the ECB will do whatever it takes to save the euro. That was a really pivotal moment, not just in the Eurozone, but actually generally over the course of the summer, because it really removes that tail risk that the Eurozone was going to collapse. So if we just go onto our daily chart, just bear with us a moment. As you can see, it fits really nicely. The bottom there, just ahead of 120, fits really well with the moment that Draghi spoke. And what a beautiful candlestick pattern there as well. You've got really nice bullish reversal, a bullish engulfing candlestick, nice double bottom, suggests that 120.50 is ultimately the low. But what we're interested in probably is more longer term trading. So as you can see, we've got above some really important levels. The 21 hours crossed above the 55 hour. That's a bullish signal. We also got above that 125.75 level, which is a 100-day moving average. Going back to our hourly chart now. As you can see, got all the way up to 126.20. Now, what we do know, 126.35 to 40 is one hell of a formidable resistance zone. And the reason why it's been high for the last 3 days. So in the short term, that is a really pivotal resistance zone, largely because again, as I said, we just haven't been able to pass it. Now, the euro's done this all the way through its move higher over the summer. Take a look at the daily chart again. It tends to move higher, move sideways a bit, move down, move higher, move sideways a bit, move down, move higher, move sideways, move higher again. But this sideways movement has been very, very typical of this rally that we've seen in euro dollar, which suggests that maybe it lacks a bit of conviction. It also suggests that, the volume isn't there, and we do know that. Volume hasn't been there. Sorry guys, I'm just going to check that you're all there. Great. Volume hasn't been there over the summer. We're hoping it's going to come back in September. We know that it came back with a bang on Friday during Bernanke's speech. We expect something similar during the ECB conference on Thursday. So, volatility is coming back. But it does suggest to me, what this pattern suggests really is that when we've reached some certain high levels or key resistance, there's been selling pressure. And we're seeing that again at this 126.40 level. As you can see, we've come off. 126 is holding. Below there, we get kind of 125.75. As I said, 125.75, really pivotal support now. The reason why it's the top of the daily it's the 100-day moving average. And also it's the pivot point too. So, that's a really important level. As long as we stay above 125.75, then we could potentially have another retest of that 126.40 level. But where do I really see us going over the next couple? I'm not really willing to predict further out than that because, again, this ECB meeting is kind of all up for grabs. We don't know what is there yet. But with this 126, as I said, 125.75 level, if we can stay above there, I do believe that is important, largely because do we rally into it? Do we rally into this ECB meeting, even though there's an awful lot of unknowns there? Then we may be mildly disappointed if the ECB doesn't come out with the big guns. It's a very difficult time to trade the euro dollar, but there can be good gains out there. I tend to think that we possibly won't rally into it. However, we could potentially drift down or stay in a bit of a range between 125.60 to 70 on the upside. So not a convincing break lower below that 125.75. And then 126.40 on the upside. So as I said, in the next couple of days, if we get to that 126.40 level, I'd look to sell. Likewise, probably look to buy around that 125.75 level because I think that will be quite important support. But I would also keep my, I'm talking kind of intraday here. For gains of kind of 50 to 60, say 50 to 100, say 100 pips, which means that I'd probably have, if I want to keep that kind of 3-to-1 risk-reward ratio, only about a 30 pip stop. And that, the reason why is because I'm trading on a very short-term basis. Now, it's that type of trading that does require a lot of concentration from you as a trader, and also a lot of, checking the markets and whatever else. Make sure you keep the stops in there and just make sure that you have kind of realistic gains. But, for example, you could have you could enter in 125, you could have your stop at 125.45, because I believe kind of below that 125.50 level, then I'm really wrong in what I'm saying. And look to maybe target kind of 126, 40, maybe even 126, 75, because I think, if we get above that 126.40 level, then there will be, a push higher towards that 127 level, but then we'll try to come off. So looking for kind of short-term gains at this stage, or short-term trading, range trading strategy as we lead up to that ECB meeting. That's kind of what I see going on. Now, what happens at the ECB meeting? Well, that will be important. I'm not going to have a position on at the ECB meeting or during his speech, and I'm not going to put one on during the speech either, largely because, he could say absolutely anything. We have no idea what he's going to say, what Draghi's going to say, what direction he's going to go in, whether he's going to bring out the big guns. It's politics. It's too difficult to know. We're not on the inside. We're not flying the wall during these ECB meetings. We have to digest what comes out of the ECB meeting and then go from there. That is, digest what comes out of the ECB meeting, and then we'd look to. So once we've done that, we would then look to. I then look to kind of see where the dust settles. If it's been a disappointment, obviously, try to establish some sort of short position at a good level. And again, if it's positive, then I'd probably try and jump on it maybe after the speech once I'm sure that's the direction he's going in. I just don't want to get caught up in that whipsaw reaction. The one thing I would say is the ECB meeting is just one of many event risks for the euro over the next kind of month or 6 weeks or so. We not only have that, we've got Dutch elections, we've got troikas going to Greece, we've got Spanish banking sector funding requirements being registered yet again. We've got so much going on that the ECB meeting is just one part of that puzzle. Very, very important part, central part, you could say. But if we get a disappointment there, we might get a positive surprise somewhere else. So just beware of that. The ECB meeting is super important, but it is, worth. Just another thing as well, just looking at the MACD, the momentum indicator isn't anything here. It certainly isn't everything. Let me also just add an RSI. Hang on one moment, bear with me. But as you can see, kind of fallen, but kind of isn't telling us too much. Suggests that, we've come off those highs. That 126.40 level seems to be the high for now. That seems to be when we're getting into that oversold territory. And then we're backing away from that 126 level. So right now, it does look like kind of we could potentially move back lower, back towards that 115 level. We've really then backed away from that overbought level, which could actually be quite a positive thing for, for establishing a short-term long. So again, yet again, kind of momentum indicator also supporting that. Sorry, bear with me one moment. Also supporting that range trading strategy. Okay, the other thing I want to show you, euro yen, just as we lead up to this ECB meeting, euro yen, as you can see here, literally oversold on the MACD, also looking quite oversold towards that kind of 70. Yeah, I mean, above 70 there now in the RSI, or it certainly was anyway, which really suggests that 99 is quite a tough level. I mean, that's a tough resistance level. People are coming in to sell right now, and we are still stuck in a range. Now, this is an hourly chart, and as you can see here, nice range going on for sure. We've got kind of the upside there at 99, the downside around about that 98 level. There's some interim 98.30 or 25 to 30. We are looking very, very overbought, as I said, at 99. We have come off from there. What this pattern really shows me is that there's just a lot of congestion around this area. We've dipped lower all the way back to 98.75, but we're really oscillating. I would say in the next couple of days, as we lead up to that ECB meeting, the fears maybe walk in. We could potentially sell the rumor, maybe buy the fact. Because remember, we have been rallying in euro. So what we could see is a bit of weakness coming in here with people establishing shorts around this level. So between this kind of 98.90 to 99.10-ish level, looking for a move back to this hourly SMA cluster here at 98.50. And as I said, backing away yet again on that RSI takes us away from that massively overbought area. So, these short-term kind of sell positions could just be in place. So that's just really trading the range. If you kind of want to trade that ECB meeting, I would say don't trade during the meeting, but in the next couple of days, today, tomorrow, we could see a bit of weakness coming in, which could which gives some very short-term opportunity for those of you interested in the shorter-term trading. So as I said, in a bit of congestion here, and we could come off quite sharply as we head into as we move towards that kind of 99 level. Again, that seems to be an area where we're attracting a lot of profit taking, a lot of sell interest. Euro yen, again, as I said, euro yen is a real, as we lead up to this ECB meeting, it's going to be a real safe haven trade. It's going to be the trade that you're going to watch and that you're going to be looking at, especially since Euro Swissy is, it's pegged. It's so, it's controlled. Now that we're kind of in the way of that, then what we're really looking at is, euro yen being the kind of the more interesting. That seems to be the one to watch. Certainly the big risk barometer. Now that we're at euro at yen crosses, let's just take a quick look at dollar yen. Obviously, dollar yen has been. This is dollar yen chart. This is daily chart, as you can see, looking incredibly within its range. Sorry, I keep going back just to check on you to make sure you're all right, that you can all hear and everything. Dollar, incredibly. It's incredibly weak within its longer term range, as you can see, so far away now from those highs reached in March. It's just, getting weaker and weaker. But Angie's speech, whereby she didn't quite say that there would be more QE, but he certainly pointed towards that direction, also suggested that would be his favoured policy tool, which very much meant that, yes, okay, fine, he didn't give us a date for when QE is going to take place, but he certainly kind of pointed us in the direction of the fact that, if he would pump in the economy left, right and centre with more stimulus. And as you can see here, certainly on a long-term basis, we're just drifting sideways. The market isn't willing to rally. It's not willing to rally on an anti-QE mark because Bernanke was too dovish at that Jackson Hole meeting on Friday. Likewise, it's not willing to go too much further, too much lower, because we just don't know. There's too many unknowns. We don't know when more QE is going to happen. We don't know if the rest of the ECB supports him in that way. As you can see, we seem to have made quite a nice bottom there from Friday at 78.20. 78.50 is 50 to 60 area. It's quite a formidable resistance zone. Not only is it the high from last week, before we fell off. But it's also quite close to the 200-hour moving average. How I see this kind of pair moving, I see this pair like being very, very tight and stuck in a very tight range between 78.20 and 78.50 for the next couple of days, and for it really waiting for the non-farm payrolls report on Friday. They really does get moving. Remember, it's not just the ECB meeting this week that's important. It's also that non-farm payrolls report. If we get a strong non-farm payrolls report, and by that I mean about 160, around about the same range as we got for July, which was 163k, I can't see how we can rally here. I can't see how we can expect more QE and how we could expect the yen to rally. I would expect the dollar yen to kind of jump above that 78.77 and then move towards 79 in the short to medium term on the back of a good non-farm payrolls number. Of course, if we don't get a good non-farm payrolls number, that becomes a bit more problematic. But as I said, right now, very, very much range bound. These are the levels to watch out for. 78.20 on the downside, 78.60 on the upside. Okay, the other thing I wanted to look at, as I said, gold. Let's take a look at gold here. Gold is, it's sort of have on actually during this period when central banks are very active. Central banks trying to, limit volatility by keeping long-term interest rates low. And as you can see, this is Bernanke. This is a reaction to a dovish Bernanke. That is a $40 jump in gold. Since backed away from that 1700 level, testing good support there at 1690. Any move down towards 16, just below 1680 is probably a bit of a buy. But as I said, could be very, could really drift into payrolls and a very weak payrolls number, say around about that or 120 level, and we could see this pair really shoot above 1700. Now let's take a look at the longer term chart, and as you can see here, flatlining really, which just shows that we are waiting to hear from both the ECB. But I believe the bigger event for this pair is going to be that non-farm payrolls level. And if we do get a weak payrolls number, that really will sew up or guarantee pretty much expectations of QE at the September Fed meeting. That could see us jump to kind of that 17 inches, that high from March, ahead of kind of 1750, and then there's not too much in the way between there and 1800. But the one thing I would point is that we probably won't go in a straight line. This sell-off very, very normal. Remember, we are at overbought levels in gold at the moment. That jump higher on Friday has really pushed us to that 70 mark in the RSI. Remember, 70 is considered overbought, just there could be a bit of a sell-off. Looking at it from an hourly as well, we have turned lower, so there could be a bit lower to go. But maybe not too much. You may get back, maybe even a pullback to that 1680 level. Again, depends on manufacturing today. We've got the years in services sector survey as well. All of these things are going to be important, so watch out for them. Data watching when it comes to central banks really are pivotal. So we've got this. So we have got this 60, as I said, this is a manufacturing survey today. If that's stronger than expected, no QE, we could see gold come off quite sharply. If that's fairly weak or in line with expectations, then we could see it, the gold price shoot higher again. But as I said, I believe it's going to be non-farm really determine the direction for this pair for the medium term. Now, I also wanted to talk to you, just double checking that everyone's okay. Yeah, looks like you are. Pound as well. Now, the pound has been an interesting one. It's done fairly well over the summer, as you can see. Now, this is a short-term chart, but, just even looking at it, it's had quite a nice, balanced, steady move higher. If you put your bet on below 155, even down to that 153 level, you would be laughing. You're up. You've had this summer. It's been slow and steady, with a few worrying trends at the time. But overall, that let me just draw a trend line here. Just bear with me one moment. Nice trend line higher there, and haven't had too many times where we've broken below it. But basically a series of higher lows, which has all been good. And again, a series of higher highs. Oh, I'll start you later. Looking at 159.12 is a really pivotal support level. Then kind of 155, which is the top of this upward channel on the daily chart, towards 160. Now, the one thing, just looking at the hourly here, what we saw earlier on was we saw the price moving higher, but yet we've seen hourly MACD moving lower. So there's some divergence there, which suggests that we could fall off. So if we do drop below 158.85, that is quite a big move. Could see us down to 158.50, potentially down even then towards 158. However, with this kind of dovish Fed combined with the bang on hold, that upward surprise we got from the PMI manufacturing data last week, if that can follow into the services sector, so if we can get an upward surprise, in the market at the moment expects 51. If we do actually get a 53 reading of that, and remember that's released tomorrow, then we could see, pound make another stab at that 159.12 area, potentially then towards kind of 159.65 and 160. But I am concerned about this divergence here. It's pretty clear to me that there is divergence. And again, it suggests we could see a breach of 158.8. Again, I think, the pound is a bit of a wallflower in FX at the moment. It is tending to move with, with kind of getting moved up in the wash between what the ECB is doing and what the dollar's doing and what the Fed's doing. So, don't expect kind of a clear-cut direction for the pound. But obviously better economic direct, but we do know that the pound reacts very well to positive data expectations. So in the short term, there could be some flurries higher. But however, in short term, there could be some volatility because you could get that positive economic data surprise. However, this divergence here with the MACD is a bit concerning to me. Just on the hourly chart suggests we could be in for a bit of weakness. Usually when they diverge, something happens and it suggests that maybe this kind of move around about that 150 level isn't necessarily going to last. We could see a bit of a pullback. But because it's only the hourly chart, not the daily, it doesn't suggest that we're moving. We're going to have a significant move lower. Maybe it's just a normal pullback. But that certainly is one to watch there. Okay, let's look at the Aussie as well. It's been quite an interesting week for the Aussie. It's come under a lot of pressure recently. We've also had, we've had weak commodity prices. We've had bad news out of China. And then the domestic front has been pretty mixed. We had, a less dovish than expected RBA meeting, an RBA statement this week. That is kind of important to watch out for. The one thing I'd say, obviously, this is looking at an hour at the daily. We've come off quite sharply. We've fallen through some major support zones, but we have found some good support around about that 102.20 level. Let's just take it back a notch now, back to this 60-minute chart. That 102.20 to 30 level, really good support. It seems to be a temporary low right now, but we don't seem to be able to make a push towards 103. The outlook for the Aussie has been, fairly weak. It's broken away from what the Euro's done, as the Euro's had its nice move higher over the summer. Let's just go back to the daily chart. As you can see, the Aussie is for kind of weak commodity prices, weaker China. It's been fairly resilient, or it's been fairly, it's not moved with the sentiment that the Euro has, that European stocks have. In the sense of, the ECB is going to save the Eurozone no matter what. It's moved based on pure fundamentals. I would say the Aussie at the moment is a pure fundamental play, and those fundamentals are still weak. It still says global growth is weak. When you're a commodity producer, it doesn't matter if the ECB is going to get it in the next 3 years to really support itself and get itself out of the crisis. What matters for you is the next 3 to 6 months, and whether or not, we're going to see growth, essentially. And if we don't see growth, then that is bad for commodity prices, which is bad for commodity producers, terms of trade for people like Australia. And that's primarily why I see the Aussie as being, the ultimate fundamental play at the moment. We are looking at, we're looking here at quite a weak pair. 102.20 holding for now, but there is a risk of kind of a breakdown. So this double bottom here from the second week of July, which is 103.40, and then parity. I wouldn't be surprised if we saw parity. I really wouldn't. For me, there would certainly be a possibility of doing that, largely because I don't see China having bottomed yet. I don't think that anyone can say that it has right now. I also think that, yes, we might not get any more rate cuts, which kind of protects the interest rate differential. So in the next kind of week or so, we could see a bit of volatility in the Aussie, whereby it moves higher, especially if we get a dovish Fed or a dovish ECB. However, if we don't get those dovish moves from those two central banks, then I believe the Aussie could be at risk. Because again, as I said, it's a fundamental play, and the fundamentals suggest things are still weak, especially in China, which is Australia's largest trading partner. Okay. Guys, that's it from my presentation. Do you have a couple of questions? Because I'm more than happy to take a couple of questions. Now, just let me know. I've got another 5 minutes. Someone just asked when I'm on next. Well, I'm going to be on every Tuesday at this time. So it's 10 a.m. London I start. Not in the mornings anymore, but every Tuesday, as I said. Do please join if you can. Hopefully this is a good time for you. It's called Trading Tuesdays. It's just setting you up, giving you a few really just to think about as we lead up to main events, just to kind of get you kind of trading, trading juices flowing. At the moment, I am only doing once a week. We will review that going forward, but just once a week for now. One of my colleagues is going to be taking one as well. He's going to be doing one on a Thursday, I believe, but in the next few weeks going forward. But please, those of you who do like these webinars, do try and join me for once a week. I'll certainly try to I'll certainly try to give you a really good overview and also point you in the direction of my other research. You can keep up with us on a more frequent basis using Twitter on Forex.com is our tag name. Also Forex.com, which is our website. Under the research tab, that's where we keep all our research. So do look out for us there, but certainly on Twitter, I know I'm tweeting hundreds of times a day. In fact, I'm doing that more than I am longer form pieces of research these days, but you guys seem to like it, so that's all good. Someone just asked, is it possible to have a weak Aussie but a strong euro? And really, yes, it is, and that's what we've seen over the last over the summer. We have had that, and we've seen, the Aussie really break away from the euro. But as I said, I think because the Aussie is more reacting on political changes in the eurozone and sentiment changes to the eurozone, whereas the Aussie almost doesn't have that luxury because it is so reliant on economic data and on people buying it and keep it in this strong physical position. It reacts more to fundamental data, and right now that fundamental data is still very, very weak. Okay, the other thing I just want to show you quickly, I'm going to put my chart back on. We're going to look. Hopefully you can see my chart. Yeah, you can see my chart now, I believe. Oh, it's all gone crazy. Just bear with me. Where's my eraser? Here we go. I'm just going to take off some of these. Let me just look at CAD really quickly, because the other thing that's going on is Canada's interest rate meeting. And that's tomorrow. At 2 o'clock London time. That's expected to remain on hold, or rates are expected to remain on hold. What would be really interesting is that last month we saw the Bank of Canada Governor Carney actually remain quite hawkish, and it suggests that things are in Canada, they're going to start removing policy. They could potentially tighten policy because of inflation pressures, etc. It was interesting to see in the last month commodities have been hit fairly hard. After that, we've had a very dovish Fed. Because of this, the link between the Canadian and the US, can Canada really have a tighter or a more hawkish policy than the US? And we'll have to see about that. We're not 100% sure. Hence, we could see some maybe potential rebound if he's less hawkish than expected, Carney. We could see a bit of a rebound in dollar CAD. As you can see here, really, really weak. Very close to this double low here now, just below 98 at 97.90. If we get a less hawkish than expected Carney, or a more dove Carney, whereby he's really changed his tune, we could certainly see back to this kind of 98.60 level first, and then potentially even towards kind of 98.90. There's a lot of resistance on the way up to 99. I don't think we'd get there, but I think we could see about a 100 pip move to the upside. We'll say about 50, 60 pip moves to the upside in the short term, maybe even kind of 100 pips over kind of the next couple of weeks as we lead to that FOMC meeting. But it could be CAD negative, so do watch out for that meeting from Carney, which takes place tomorrow, and that's a bit of a meeting. That's going to be important. Obviously, payroll is very important for this pair as well. Remember, what we tend to see is that a strong payrolls number can sometimes actually be euro CAD positive, and can be negative dollar CAD because the CAD is a bit of a proxy for trading. For trading. Now, someone's just asked a quick look at the Kiwi, and I'm going to do that. That's going to be the last thing I look at today. This is the Kiwi dollar, as you can see. Kiwi dollar really been a bit in the doldrums today. It hasn't really joined in that Aussie rally. As high as kind of 80, but then fell off again. We seem to be bottoming though. We may have put a short-term bottom in just ahead of that 79.50. Looking at it from an hourly basis as well, you know, very similar to the Aussie in the sense that we haven't had a fantastic summer. It hasn't fallen off as sharply, but it is below some key resistance levels. So massive resistance level there at 80.40. And, you know, some good support there, about 200 pips below there, 78.40. And they're the kind of the levels to watch out for, but it is looking fairly weak. From a MACD and an RSI perspective, it's moving lower. From a hourly perspective, again, you know, he's not really telling us too much, just that we could move around sideways a bit. We think this pair, you know, what's it going to be moved on? It's going to be moved a lot on what goes on with Fed, we believe, and that makes payrolls really pivotal for it. So, you know, we think kind of moving sideways between maybe kind of 79.30 on the downside, 80.30 on the upside, as I said, that 100 pip range. For the next few days. That seems to be the range that we're in. We think selling plenty if we get over 80 then 80.40. Buying pressure around about below that 79.50 level. So some buying pressure could come in, or buying interest come in between that kind of 79.30 to 79.50 level. With people looking for about 100 pip gain. But as I said, payroll is going to be really pivotal for that. Okay, everybody. I hope that was useful. Thank you so much for joining. Let me just turn that camera off. And I do hope that you can join us next week. Again, thanks again. Join me next Tuesday, whatever, half an hour, 10 o'clock London time. It was great to have you, and thank you very much for rejoining. I know it's been a while. I appreciate you coming back, and watching it at this time. So, thanks again, everyone. Bye bye.